So Nexa Resources just dropped their Q3 earnings, and it was a bit of a head-scratcher. The numbers looked kind of mixed, but the stock, it just took off. So what's going on here? Well, that's exactly what we're going to break down. We're going to dig into the numbers, get a feel for what management's telling us, and figure out what it all means for the stock.
All right, here's how we're going to tackle this. First, we'll hit the big earnings numbers. Then, we'll get into the good stuff, what's really happening on the ground with their operations. From there, we'll see what they're promising for the future, and then we'll wrap it all up with our take on the whole thing, a rating, and even a potential trade idea.
Okay, let's jump right into it. The headline numbers. You know, at first glance, these really did look like a puzzle. You had this great beat on revenue, but then a miss on the actual earnings. A bit confusing, right?
Yeah, it was totally a tale of two stories here. On one hand, adjusted earnings per share, well, that was a miss. Came in at -3 cents when the street was looking for a positive 11 cents. Ouch. But then you look at the revenue, $764 million. They absolutely crushed the consensus estimate of around $65 million. And adjusted EBITDA, super strong at $186 million. So you see the disconnect.
But here's the kicker. The market didn't seem confused at all. The stock shot up over 6%. So what gives? What did Wall Street see that simple EPS number didn't show? Clearly, investors were digging deeper, looking right past that headline loss to something much more important.
And the answer, my friends, is all about what's happening on the ground. The real story this quarter wasn't in the accounting, it was in the operations. That's what lit a fire under the stock. Real, tangible progress at their actual mines.
And check this out, this is the key. Zinc production jumped 14% from just last quarter. We're talking 84,000 tons. This wasn't just a fluke, it was driven by a record-breaking performance at their most important growth project. This shows everyone that the turnaround story they've been talking about, it's not just a story anymore. It's real, and it's happening right now.
And man, you could just hear the confidence in management's voice. The CEO, Ignacio Rosado, basically said, look, we're executing, we're building momentum, and we're getting it done. He was sending a crystal clear signal to the market. We keep our promises.
And that execution is so critical because pretty much everything for Nexa right now revolves around one thing, the Aripuan mine down in Brazil. I mean, this isn't just some side project. It's the absolute cornerstone of their whole growth plan. It's the key that's going to unlock a ton of cash flow for them.
And the progress there wasn't just talk, it was real. They talked about it a lot on the call. Zinc output from that one mine, it surged a massive 70% from Q2. Plus, and this is a big deal, they got their 4th tailings filter delivered. Now that might sound technical, but it's a critical piece of the puzzle they need to process all that ore. Getting it on site takes a huge amount of risk off the table. It means they're on a clear path to get this thing fully running in the first half of 2026.
Okay, so what about their other big project? That's the Cerro Pasco integration in Peru. And guess what? It's pretty much the same story there. Management is just ticking the boxes. Steady progress, construction is moving along, they've got the equipment they need, and they're planning for the next phase. It's just more of that quiet, heads-down, disciplined work.
So what does all this digging and building actually mean for the bottom line? Well, it translated into something investors absolutely love to see. $52 million in free cash flow for the quarter. That's the payoff right there. All that hard operational work is turning into cold, hard cash that makes their financial position that much stronger.
All right, so the operations are humming. But what about the future? Let's look at what the company is actually promising, their guidance, because this is where they show us the financial plan that's going to back up all this great work in the mines. And the message here was really simple: stability and discipline. No surprises. They're sticking to their spending plans, the project timelines are locked in, and their number one financial goal? Pay down debt. They have a really clear target to get their net leverage down to about 1-to-1 with their earnings.
And they didn't just talk vaguely about it. During the Q&A, the CFO, Jose Carlos de la Valle, he put a number on it, a big one. He said the goal is to slash their gross debt by $500 to $600 million over the next 4 years. Now that gives investors something real to hang their hat on. It's ambitious for sure, but it feels credible.
And it's not like they're trying to do this in a tough market either. All this internal discipline is getting a nice boost from the outside world. Management kept pointing out that the market for zinc looks pretty good right now. Inventories are low and demand is strong. Especially with the whole global push for decarbonization, it's like they've got this nice tailwind helping them along.
Okay, so let's put all the pieces together. What's our take on Nexa from here on out?
I mean, after a quarter like this, where the real story wasn't the headline number, but what was happening underneath, a very clear picture starts to form.
And just look at this performance gap. It is wild. Over the last year, Nexa stock is down almost 21%. Meanwhile, the broader metals and mining sector, it's up 47%. That is a huge difference. And right there, that frames the entire opportunity. If, and it's a big if they can keep delivering like they just did.
So based on that turnaround we're seeing, the catalysts we know are coming, and that massive valuation gap, we're initiating coverage with a rating of outperform.
Our thinking is pretty straightforward, really. The momentum on the ground is legit. Getting that Aripuan mine de-risked gives us a clear path to a huge catalyst in 2026. They're making the cash to pay down debt, and as they keep proving to the market that they can execute, we think that big discount the stock has compared to its peers, well, we think that's going to shrink. A lot.
Okay, last part. Let's talk about the trade. How could you actually put this idea into action? And look, this isn't a recommendation, it's more of a thought experiment, how you might think about this if you were building a case.
So the real question is, how do you position yourself to capture this potential upside? I mean, we're talking about catalysts that are going to play out over the next year and a half, all leading up to that big Aripuan moment.
So here's one idea, kind of outrageous, but definitely plausible. You could use long-dated call options. By going way out, say to June 2027, you give this whole story plenty of runway to work. That date is well past the Aripuan ramp-up in 2026. What this does is it gives you leveraged exposure to the entire thesis, the mine ramping up, the cash flowing in, the debt going down, and hopefully that big valuation gap slamming shut.
And as always, we have to say it, this is not financial advice.